All right, while things may look good, our next guest says it is time to reach for some stability because things may not go back to normal ultimately. Joining us here on set is Henry McVey, KKR partner and head of global macro and asset allocation. He is the CIO of KKR's balance sheet. Henry, great to have you.
Thanks for having me.
I go back to, I think you've been saying for a while that the global economy has like a higher resting heart rate, right? The metabolism's high. Maybe it means inflation stays higher. There's a lot of fiscal going on. There's a lot of building that has to happen redundantly and deglobalization. What does that mean right now for an investor where you're looking to deploy capital?
Look, I think our premise since coming out of COVID was this time is different and that this kind of regime change, right? Bigger deficits, more geopolitics, messy energy transition, and as you said, kind of higher resting heart rate for inflation. So what do you want to do? We think you want to own more things kind of linked to nominal GDP. So in the private world, that's been a lot more around infrastructure, or for lending, we actually want to own a hard asset that does well when there's a little inflation in the system. I think globally, people are off sides. I go to Asia all the time. Japan continues to go up. You look at Southeast Asia, all those markets are moving and they're under-owned, and that's happening at a time when earnings inflected upwards. And so I think there's a lot of consternation about geopolitics. I think that peak tariffs are in. So I think that's an important point. And I also think that that we're going to see stronger currencies outside of the dollar. And if you get a tailwind from currencies, earnings are going up and the stocks are cheap, that part of the market's going to move. We've been incredibly active in India. We've been incredibly active in Japan. And I think those markets do well. And in Europe, we've really focused more on kind of what I would say the peripheries. If you think of a Spain relative to some of the core of Europe, that market remains very attractive for us.
Is part of the appeal or what's working in, let's say, Asia in particular, that it's earlier in whatever cycle than we are here? Because I know you feel like, look, whatever you say about the good conditions we're in the U.S., it's somewhat later cycle, and maybe you want to kind of go up in quality.
So I think there are two kind of big things. One is there's so much liquidity in the market right now relative to the issuance that things are crashing. Like credit spreads, you can move up from triple Bs to triple As, and it doesn't cost you much. The quality index in the S&P, you can buy cheaper quality. So you should be doing that. I think longer term, what we're seeing though is we're in a productivity boom, and everything linked to that globally is going to do well. We just had 5% productivity in the U.S. The cheaper way to play productivity may actually be through Korea or Taiwan and Japan, where a lot of those markets are trading at less than book value. So we've been in a kind of, the Mag 7s had a stranglehold on the market globally, and so most people are overweight the U.S. I think they're going to do okay, but I think you're going to see healthcare do better, financials do better, and Asia do better. And so I think that's going to cause people to chase a bit. That was the story in 25. I think it'll be the story in 26. What we've been doing from our standpoint, because there was a lot of money that flooded in the private markets in 21, is we've really turned our playbook to focus more on corporate carve-outs. I mean, you guys report on this all the time. Activism is coming after companies. There's a huge amount of activity in Japan, Europe, and in the U.S. around corporate carve-outs. That's a big area. Infrastructure is a big area. And then in credit, there's been a lot of noise around direct lending. We don't think that that's the beginning of a crisis. We think it's the beginning of a credit normalization, but we've also been tilting the portfolio towards owning more real assets, more things linked to nominal GDP in our asset-based finance business, and the spreads there are still very attractive.
How do you think about rates and how it impacts the environment? You mentioned Japan, what we're seeing with JGBs and yields there. It's basically pulling yields up around the world. So how does that impact how you view where to put your money?
I think it's a great question. I think that Japan is the epicenter. Most people come in and they want to focus on the U.S. Treasury, and that's what being in the U.S., that's what you focus on. The area of most negative real rates globally in the big, large markets, by far, is Japan. So that's where you need to focus. I do think there's a governor where the central bank and the prime minister can't let rates go up too fast. But I've been going to Japan for 30 plus years. They're going from deflation to inflation. And it's one of the reasons the market is so interesting, because you can borrow very cheaply in a higher nominal GDP environment. But that bond market does need to normalize. So we're going to have that tension. But I think this government is really committed to corporate reform, return on equity is going up. If you talk to our founders at KKR, they would say, put me in, as an analyst in Japan right now, and help me do some of the kind of the strategic buyouts that may have been more akin to what they did in the U.S.
Like going back 40 or 50 years.
Yeah, it's a little bit back to the future.